Welcome back to the Home Path Podcast. This is Raphael. Today we're going to talk about beyond the interest rates, the true value of owning your home. It keeps some people tied up because they get so fixated on the rates that it keeps them hesitant from moving forward. So we're going to explore the real value of homeownership and beyond those numbers. So a lot of things that you don't consider is one of them, building equity versus paying rent. So you may get a rent increase every single year versus building equity where you lock yourself in for 30 years at a fixed rate. It doesn't matter if the rate is higher, lower. A lot of people think that interest rates will go back to like around pandemic prices like 2 or 3 or 4%. And the reality is that we just had a Fed announcement and they're not moving the rates. So what does that mean for you? So if you've been trying to buy for many years, the one thing is true is that the property value just keeps going up and up. I think we're past beyond this philosophy that the homes are going to decrease in value. There is no inventory, and everybody who is locked into a low interest rate does not want to move. And rightly so, they have a really low interest rate, so they don't want to touch it, meaning they don't want to sell. They'd rather just stick it out because they know that they're not going to be able to get an interest rate in the 2s or in the 3s. It'll nearly double from what they're looking at right now. But one thing is for sure is that the equity has gone up. And equity is when you start paying down the balance and the value goes up. So you're doing two things. Think of it like a S-curve. The value goes up over time, which in 2025, they're predicting anywhere from 3 to 4%. It won't make you a millionaire, but over time, it adds up. Let's say over the next 10 years. And then you're also paying down your balance. So you're doing two things at once, which builds your equity versus paying rent. Because when you pay rent, you don't pay any debt off. All you're doing is just, paying rent. So if you've already done that, you can continue to do that. There's nothing wrong with it. There's absolutely nothing wrong with renting. But if you know that every single year you grunt every time you get a notice of the increase of rent, then this is for you. Because a lot of times you're not looking long-term, you're looking short-term. So I like to advise people more like a long-term vision of what they're going to do, because that way they're thinking ahead of what's going to happen in the next 5 or 10 years. Let's also talk about the tax benefits associated with the mortgage interest deductions. So what you'll notice is that every single year you're going to get a letter from the bank and saying, like, this is how much you paid in interest for your mortgage. And you can take that to your tax accountant and help you out getting some tax deductions for the interest that you did pay on the mortgage. There's also long-term financial stability through the property appreciation, because a lot of times you're not moving, you're not doing much, and the cost of moving is very costly. If you haven't moved around much, you lose time from work, you lose productivity, and then it's just very costly to move. And then there's also just the benefits of just you knowing that you're going to own that home. So if you want to do anything to the backyard, if you want to paint the walls, anything like that, it's always, your discretion. If you want to convert the garage to a home gym, you can always do that. And then there's different strategies to offset some of these higher interest rates. And some of those strategies could be that maybe the seller has had a hard time selling the home. So what they'll do is, instead of covering your closing costs, they'll just apply that as a seller concession to buy down the interest rate for the next 2 to 3 years. And that is called a interest rate buy down, where the seller buys down your interest rate for the next 2 to 3 years. It can be very costly, sometimes $10,000, $15,000. But instead of paying your closing costs, what that'll do is it'll help you have a lower payment for the first year. The second year, it'll go up a little bit more. And then the third year, it'll go back to the normal payment. And who knows what will happen with the rates by then, but it'll help you in the short term to alleviate the payment, start paying down the balance, and get yourself into a property. Now, it doesn't mean that you will be able to qualify for the lower interest rate, because you still have to qualify as if you were paying the final interest rate. So if, let's say, interest rates are 7% right now, you'll still need to qualify for that rate. It doesn't matter that you're going to be paying less right now. Everything's going to be based on what your 30-year fixed rate will be. So that is called either 1 buy down, 2 buy down, or 2-1 buy down. And it doesn't happen often, but that's one way you can offset the higher interest rates. And just know that at some point, you will be able to refinance. We don't know when that will be, but one of the things that you'll have to consider is when you're looking at interest rates, do you know what the difference is in payment that you're going to be paying? And there's a lot of ways for you to throw off that interest calculator. You can also look into this by just Googling, the interest rate calculator on a mortgage, where you can offset this by always being a payment and a half. So let's say tax season comes around and you're able to, instead of just spend the tax money, that the tax refund that you're going to get, you can always be a payment and a half in advance on your mortgage and then offset the interest calculator. And what will happen is that you're always going to be a payment and a half in advance when you're making your payment. So more is going to go to the principal and less to the interest. You can do this with car loans as well, because they're called installment loans. So you can also, Google how to do that as well, but it's not too hard. A lot of times people live paycheck to paycheck, so it's really hard for them to be able to pay down their mortgage or be a payment and a half in advance, because it can be a big substantial amount. Not everybody can do it. But the tax season is a perfect time for you to grab some of that cash and be a payment and a half in advance. So you're paying down the balance a lot faster. And if you've ever heard the term, or people talk about paying down their mortgage in like 15 or 20 years, this is what they did. They were always a payment and a half in advance. It's no like magic wand. It's just that they're throwing off the interest calculator. So more is going towards the principal and less towards the interest, without refinancing or doing anything like that. So that's a great opportunity for you to also pay down the balance a lot faster. And then within time, you can go back to the bank and you can ask for them to refinance your loan. So what that means is they're going to take a look at your current balance, because you're going to go back to them and say, hey, I don't owe the same amount as I did when I first bought the property. And I do see that interest rates have dropped significantly. So could you restructure my debt or my loan based on my current balance and based on the current interest rate? And a lot of times that's when your payment can drop a couple $100, $500. It just depends on your balance and how much your rate's going to drop. And that's called a refinance. So don't think that because you have a 30-year mortgage that you're going to stick with that mortgage for the next 30 years. I think a lot of people have a misconception that they're going to be stuck in a 30-year term. You can always go back and refinance it. It's just when you first get in there, you think that you're going to commit to this for the next 30 years. And that's not the truth. You could sell the home and get rid of the loan, right? It'll be paid off and then you're done. No more 30-year mortgage. Or you could be a payment and a half in advance and pay it off sooner. You could also refinance it when it's time to do that. And if you're diligent enough, if you're disciplined enough to be able to either do some side jobs, collect your tax refund, sell some stuff around your house to be able to come up with an extra payment and a half, do some overtime. There's a million different things you can do to come up with that extra payment and a half. And then you're always throwing off the interest calculator, and you're not having to worry about having this quote unquote interest rate, because it becomes irrelevant now, because now you're throwing off the interest calculator. So there's a lot of different ways to get around this. The one thing I don't want it to paralyze you from preventing you from buying a home, because while you wait for prices to go down, interest rates to go down, you're always making your rent payment, which doesn't go towards anything. There's no tax benefit to it. There is no equity in it. And there's really not a whole upside. I mean, there's a lot of situations where you have to rent because you can't physically do it. Maybe you have, this really bad credit score, you have some things you need to take care of, and that's okay. You can always work towards it. But if you have the capacity and you are able to buy I don't want it to hold you back because there are creative ways for you to get around this mindset about just the fixation around interest rates. So I hope that helped you, gave you some clarity, and we'll see you on the next episode.